Shopify stocks are giving more pain to the investors as its stock has dropped more than 80% on Wednesday after the company has predicted that the revenue might get slowed down in the initial 2 quarters of 2022. The growth stock has declined up to 50% in the prior 12 months. Moreover, the stock price has declined by $20 in just 2 days. These are the pains that no one ever expected about a year ago when things were going fine at the time. What's up guys, welcome back to Glory Investing Show. Now in today's video, I'm going to talk about the latest updates about the Shopify stock and we'll discuss in detail its Q4 financial results for 2021. Now, Shopify stocks are down due to the reason of management outlook. They say that growth would be slower in the first 2 quarters of this year and pick up in the last 2 quarters. It is important to understand why in 2021 Shopify had huge tailwinds because of the COVID-19. Now, the world is recovering from the global coronavirus pandemic and buying behaviors of people have changed. In fact, in the first half of the year, the benefit is not accepted to be repeated since there are no lockdowns being imposed across countries. So comparisons to last year's revenue are going to be a bit more difficult. Here, it is important to note that the company has also said that the terms it had with the applications and developers in its ecosystem to eliminate revenue sharing fees on the first $1 million in revenue only kicked in the second half of 2021. This means that the company was collecting this revenue in the first half of 2021, so again, comparisons are really hard. Now you might be thinking that the adoption of Shopify's e-commerce has slowed. However, the reality is that it is not the application business is slowing, but rather Shopify is collecting fewer fees from partners, which in the long term should help the business grow. Finally, management is investing more in sales and marketing, and that is expected to impact the revenue in the second half of the year. Now, investors may be disappointed with the early 2021 growth. I would say that the management of the company is clearly trading short-term profitability for long-term growth. Now, let's get a deep dive into the financial results of the Q4 of the company. Now, don't forget to share your thoughts with us in the comment section below. And with that being said, we will now discuss the financial results of the company for the last quarter of 2021. For the quarter, the revenue of the Shopify company rises up to 41% to about $1.4 billion. Analysts predicted that the Shopify earnings saw 1.4 cents per share on that revenue. However, a year before, the company earned $1.58 per share on much lower revenue as compared to Q4 of 2021, which was around $978 million. Though GP was around $692.7 million, which was up to 37% high from the previous quarter. The gross profit margin of Q4 was 50.2% if we compare it with the Q4 of 2020. It was 51.6% at that time. This means that the gross profit margin of the company has declined to 1.4%. The problem lies in the profit and loss account, and some of these problems lie in the balance sheet. Shopify's costs are going crazy and the company really needs to think about it. Otherwise, it will never be able to make a profit of it if it does not control its crazy costs. Here is the reason why I'm saying this. If we talk about the operating income for the Q4 of 2021, it contracted to 87%, which means that it was about $14.4 million or 1% of the revenue. If we compare this data with the Q4 of 2020, it was $112.5 million or 12% of the revenue. Due to the upsurge in the operating costs across the board, including the marketing and the cost of selling, R&D, and admin and general expenses, the net loss of the company touched the amount of $371 million for the Q4 of 2021, and that is a huge loss. In the Q4 of 2021, net income includes a $509.7 million net unrealized loss on the company's equity and other investments. If we relate it with the same previous quarter of 2020, there was a net income of $123.9 million income. The rise in operating costs fully ate the profit of the company in the Q4. It means that the company does not have control over its operating expense, but let's hope that the management is keeping an eye on these expenditures and maybe it is thinking of different ways to lower them down. However, on the one hand, you would say that it's great that the company is growing. Like the company is investing money back into more growth. So that money they're putting back in will fuel more growth in the future, and that growth will come faster. But there is an issue. Their sales and marketing costs in the Q4 went up to 78% as compared to the Q4 of the prior year. The revenue went up only 40%, so that does not instill a lot of confidence because it looks like the company is either wasting a lot of money or having to pay through the nose for that growth. The gross merchandise volume for merchant customers increased up to 31% to $54 billion as compared to the prediction of $53 billion. The company said that the income of the merchant solution increased up to 47% in amount it reached over $1 billion. The subscription solution jumped up to 26% to $351 million. However, the experts predicted that the revenue of merchant solutions would reach $985 million, whereas the revenue of subscription solutions will be around $375 million. The company continued to build the introductory features for its fulfillment network that provides merchants quick and easy fulfillment. It will make them able to delight their customers. Let me tell you that a few of the main features include demand estimation, alerts, product bundling, regional taxation settings, and also the pop-ups about the staff. The company opened the self-working leased warehouse in Atlanta. From that location, the company will start fulfilling a tiny number of merchant orders. You might also want to know that the company also started trying to fulfillment software at that point to unite the network and make merchants' links more robust than Shopify. There is a lot going on, and the main reason why Athens is spending more money is because of the fulfillment network, which is around $1 billion in physical networks across the United States. There is an expectation that this network can become a threat to its e-commerce rival, Amazon. The growth stock has declined from a stratospheric estimate to a more possible one, so it could be considered a value stock in the growing space of e-commerce. The company is predicting that its growth this year will be below than previous year, which is 57% due to the different factors. There is no doubt that the company's stocks are trading at a lower price than previously, but the financial environment is different from before. Here, it is important to note that liquidity is tightening with the market predicting the rise in the rates of interest. Furthermore, tech stocks have a tendency to raise funds by presenting equity. I would say it's not a good idea to raise funds by offering equity because of the lower level of stock trading. However, the business has low debt levels. It can somehow raise funds if it considers necessary. Let me tell you that someone who had an initial investment of $20,000 would still be worth $594,000 now. You may argue that Shopify stock long-term upward term tendency remains unbroken for now. If you're still optimistic about the e-commerce business, especially this company, you can buy a few shares here if you can stomach more instability in 2022. Shares of the e-commerce giant have already lost more than half their value this year, but what is happening inside US market is something nobody is talking about. Shopify's share of e-commerce sales in the US is second only to Amazon, and it's gaining on the leader. In 2021, Shopify's share of overall e-commerce sales grew more than twice as fast as Walmart's. Shopify is building up its position as the go-to partner for just about any business that wants to compete with Amazon's enormous logistic network. It was this news of increasing investment into fulfillment services that caused Shopify's stock price to sink after its fourth quarter earnings call. Over the past year and a half, Shopify built out a self-operated warehouse in Atlanta as a pilot study, and it worked. More visibility and control over fulfillment services that can handle 2-day deliveries and returns was so well received, Shopify will continue building and operating more of its own major warehouse hubs. Heavy investment in warehouse hubs has already started and is expected to exceed $1 billion by the end of 2024. Shopify Markets is in the middle of a big upgrade that will make it more attractive to merchants in North America and beyond. In 2021, Shopify expanded a partnership with international e-commerce solution provider Global E Online. At the moment, a majority of the merchandise sold through Shopify comes from North American merchants, but this could change things to Global E partnership. Global E Online doesn't just help North American business export their goods to a wider audience. Global E is also useful to an increasing number of international merchants that can't afford to hire their own army of cross-border trade consultants. The total value of goods sold on Shopify's platform, or gross merchandise volume, GMV, has more than doubled over the past 2 years. As a result, merchant solution revenue exceeded $1 billion during the fourth quarter for the first time in the company's history. Despite falling a long way from their peak, Shopify shares still trade for around 18.1 times trailing revenue. As Amazon normalizes ultra-fast shipping, building the only logistics network capable of competing will cement Shopify's position as an indispensable partner to the world's direct-to-consumer merchants. So, what do you think? Is it a good idea to invest in Shopify stocks, or should a person avoid investing in this company? Let me know in the comment section below. And that will be all for today's video, and thanks for watching it. I hope that you enjoyed, and if you liked it, don't forget to smash that like button. I will see you in the next video. Take care and stay tuned.